Okay, folks, welcome to another this is episode 9 of the Small Account Club. So, as a quick reminder about last week, and if you're just joining in, you don't know anything about the Small Account Club. This is a live stream that's going to be going private in January of 2024. So please use the link below, join our opt-in email list. We hate spam too. And you'll be invited to our private live streams free of charge. The reason why we want to keep them private is to avoid spam, which we sometimes get in our public live streams. And we also want to keep the conversation cozy, small, and specific. We want to stick to the topics at hand. That way I can address people's questions and we provide the most value that we possibly can out of the sessions. Also, I'll be using terminology like bullish key reversal, outside reversal bar, things like that. If you're new to technical analysis, you want to know about my top 5 favorite candlestick patterns, use the link below. It's free. Take advantage of it. So let's get to it. Let's first say hello to folks. And Sean. Hey, Sean. Happy Saturday to you, pal. And if I forget, I want to do it right now. Happy Thanksgiving. Happy Thanksgiving. Okay. So I want to revisit last week for a moment, meaning last week when we last met, the week I had was really, really good till Thursday night. Then Friday hit and pretty much all my gains on the week were gone. We closed out the week slightly positive, but not good. It was eating at me while I was doing the live stream yesterday. Then by Sunday night, when we do Sunday Night Futures Live, which we'll be doing tomorrow night, I was over it. As soon as you get the 6 p.m. opening salvo of trading in the futures markets, it was a new week. All's forgotten. So that was the week before last. Now, last week, we didn't do a whole lot. We had a very, very good week, though. The reason is that we have so many options trades on that are just paying us a lot of money right now because of the time decay, and I just didn't do anything with them. Well, actually, I managed a couple of positions. Microsoft was one. We just had a good week. We didn't do many new trades, but this week I'm seeing more setups come into play, and I plan on opening up new trades. And we're going to talk about. We already spoke about theta. Theta is time decay. Coping with a good week. Now, coping with a good week may sound odd, but the reason why I say it is that even to this day, I've been in this business for 30 years. Even though I had a very good week, didn't do much. I didn't do new trades, a little management here. It was just the time decay that paid us. That's why I love option writing. The problem is that you could fall in love with yourself. And that is by far the worst thing you could possibly do. I am no genius. I am fallible. I say that publicly because it keeps me humble. The last thing you want to do is have a great week and then go into the new trading week with the attitude that I could do no wrong. You're going to get humbled very, very quickly. So whatever dynamic that allowed you to have a very, very good week last week, that dynamic may change going into the new trading week. So we need to be open-minded and say, okay, what's changed in the market? What's changed in the force? Is there an anticipation of a Federal Reserve rate cut, rate hike, whatever? What's driving the market? So don't get cocky. In the end, we know nothing. The market knows everything. We know nothing. All we have is how in tune we are with the market. Is our pulse on the market an accurate read? And if it's an inaccurate read, will we have the humility? Will we have the lack of ego to say, you know what? No mas, I'm wrong here. I got to get out. And then reevaluate. The worst thing you could do is stay in a bad trade and then go shopping for a new trade, or thinking about how you're going to average down a bad trade. Don't do it. It's better just to take a small loss, take a step back, go to cash, have lunch, do your analysis before the market opens, after the market closes, not during hours, and do your day job. So the other thing I want to talk about is paying yourself. I know a guy, a fellow trader, and every week, without fail, he takes a percentage. He's an options writer like me, takes a percentage of his profits, buys T-bills. Every single week, buys T-bills. And the reason why he does that is to have capital reserves, but also you got to pay your taxes. At some point in time, I'm going to have to take money out of this account to pay the tax man. And the reason why you need to do that is because of a lesson that I learned in 2000. Let's revisit it. So you can see here, I have noted March 6th, 2000. What was March 6th of 2000? This is a chart of the NASDAQ composite. And March 6th of 2000 was the tippy top of the market. And I could tell you exactly where I was and who I was with and what I was doing. I was walking down Times Square when it wasn't a dump like it is now. I digress. And I was with my baby brother. I have two of them, the older one, Danny. Danny, if you're watching, I love you. I haven't spoken to him in a long time. And we were heading down to ESPN Zone to have beers and burgers in the middle of the day because we were just hanging out. He was just back from the Air Force. And so we were just goofing around. And back at that time, my business primarily was, I had long positions on mutual funds and whatnot, but I was an options seller, even as I am right now. But back then, I swung a big line of risk. I have more money now by far, but back then I took on a lot more risk than I'm willing to do now for a couple of reasons. One, I didn't know what I was doing. I had enough capital to get myself in a lot of trouble, which I did. Two, I was making a tremendous amount of capital every single month. Back then, they did not have weekly options. They just had monthly options. And I was trading PMC Sierra, a PE of probably like 200. I didn't care. Nobody cared at that time. And I had just sold, let's say the shares were trading at 165. I sold the 155 puts. So really right at the money. Something I would never do now unless I wanted to buy the stock. Fast forward, like 3 days later, I'm walking with my brother Danny through the Times Square, and I peek into there were no cell phones back then. I peek into the ESPN Zone, into the NASDAQ market site, and they had a scrolling ticker. And I saw PMC Sierra at 255, $255. 3 days earlier, I just sold the puts. The shares were trading at 165. The thing moved up $100 in 3 days. And that was just not that stock. This was the proverbial blow off top in the market. And even when I saw that, I said, this is unsustainable. And I thought I would be able to get through the month, but I didn't. Because little did I know that only a few days later, to be specific, 3 days later, the bubble began to break. And so I had those options. I tried to roll them. TD Ameritrade, I was trading with them at the time. They didn't want to hear it. They were like, you got to raise capital. So I was underwater on that trade, down bigly, and blew up that account. So fast forward to 2011. So I go to do my taxes. Actually, no, I'm sorry. It was still 2000. No, it was 2001. 2001. I go to do my taxes for 2001. I figured it shouldn't be a big problem here. Maybe I have a capital write-off. I could write off all my losses against my ordinary income. I had no idea. So I met with my accountant, and my accountant goes, you owe $30,000 in capital gains from 2000. You got to come up with that money. And I said, wait a minute. I lost a bunch of money. He goes, yeah, but you made a lot of money too. And you gotta raise capital. So what about the losses that I took? And he says, all you could do is take a write-off for $3,000 per year moving forward into unless you make more money and you wipe it out, which eventually I did. And that was the very same year, I believe, I got hit with the EMT, the AMT, alternative minimum tax. So 2000, 2001 was just an astronomical banging I got in terms of losses and in terms of taxes that I had to pay on gains from a prior year. So it was brutal. It was really, really brutal. So the reason why I'm talking about this is that I want to take you back to the whiteboard. Had I known or had I appreciated risk management, I never would have sold near the money options. I would have gone deep out of the money. I would have lost a lot less money. I would have had more time to realize, okay, this is a bubble. Had I known what I know now, I would have known to hedge. I would have just gotten out of the trade. But I didn't. Wrote it all the way down. But in terms of had I been taking money, I was making a huge amount of money. I would have been taking X amount of money and I would have put it aside in a private account, segregated from my trading account. So that way, when I went to my accountant, I would have had that money saved up and paid my taxes. The reality was I had to go in and take money out of my, I had mutual funds, which are already taking a beating. So I had to take money out of those, which are taking a beating because we were in a bear market. And I paid my taxes. So utter annihilation. So please, I share this with you because you do not want to live through that. I lived through it. I never, ever, ever, ever want to repeat it again. And thank God I learned my lesson at an early age when I was young enough to come back, which I did. Doing that at an older age, it's hard to come back from something like that. I mean, psychologically, it was brutal because I thought that I was the king, man. At that point in time, you thought that 2020 was a great bull market, 2021, 2000, 1999, 2000. Nothing like it. Nothing like it. And we'll never, ever see it again. I don't think in my lifetime. So don't get cocky, please, and pay yourself. Segregate some cash, put it in a private account, and that way you'll have capital to pay your taxes in case things go against you, because the government does not care. So that's my spiel. So last week, let's talk about the small account for a moment. Past the naked cow. Yeah, he wasn't around. I know who you're talking about, though. Matey mate, you're welcome. You're very welcome. You know, if anybody could learn from my mistakes, and truly it was a mistake. I was ignorant and arrogant, and there are no two worse mixtures when you're trading. No two worse. Being ignorant and arrogant. So I was smart enough to make a lot of money. I wasn't smart enough to keep it. So um, did you get to write off those losses eventually? So how it works is that, let's say I quit trading, I would still be paying off those losses to this day. Would I? How many years ago is that? 2000. So no, I would have paid it off already. So let's say I took a regular job and I quit trading, and all I had to rely upon was my ordinary income. To this day, all they allow you is a maximum of $3,000 per year of losses. So if you realized a $100,000 loss and you quit trading, you can't take it anymore. You lost $100,000. That next tax year, you're only going to be able to take a $3,000 write-off from that 100,000. The next year, another 3,000 until you whittle it down. Hopefully, you live that long. The government is brutal, absolutely brutal. So what I learned to do was I quit trading. I had to rebuild my cash account, and I went to school, meaning I learned about risk management. I learned about the appropriate ways to write options. I learned when I wanted to get out of a trade. I learned how ruthless the government was going to be with me, even as a capitalist, helping when I'm making money, paying taxes. They're taking that money, they're loving it. But when you lose money, they don't care at all. So you are truly on your own. So eventually, what I was able to do is that once I got back in the saddle again, I just had tax-free capital gains for about 3-4 years, and I just built back up. Took me a good 5 years to get back to where I was. So yeah, that was not an easy time. So hopefully somebody gets something out of this, and you learn. Yeah, it was quite the ordeal. Okay, so and if you have any questions about this, ask them, leave a comment if you're watching on the replay, and I'll definitely get back to you. So with not a big change in the account over the past week, and the reason is that the only trade that we had on last week was SEDG at Solar Edge Technologies. And you remember last week I said I love this trade because it's doing absolutely nothing. Then on Monday, it began to break out. So I could have stayed in the trade, but I chose not to. And the reason why I didn't stay in the trade was for this reason. One, we had less than 30 days to go until expiration. So to roll up puts, we made about 35% on this trade. So we had 35% in the bank. So I could have rolled up puts, managed the trade because my call side of the strangle was being challenged, not challenged, but a little bit of pressure getting put on it. So I could have done that. The problem is that we were still a downtrend. To this day, we're still in a downtrend. I would prefer to have not rolled up puts into a downtrend on a stock that is very volatile, A, and B, the options are going to expire within 30 days. So I already had a 35% profit. Did I want to go to cash, reevaluate, and say, okay, let's go shopping for something else? Or did I want to manage this trade and still try to eke out more of a gain here? I figured that the risk was too great, and I had that 35% profit. Take it, go to cash, look for a better play with a better risk-reward profile, unlike PMC Sierra selling at the money puts back in 2000. So I choose not to fight these fights nowadays, and it pays off handsomely. So we went to cash on Tuesday. So really not much of a change over the course of the week. I didn't do much else. So I said, you know what, I'll save the cash balance. And what I'll do is I'll wait until this session to go over trades we may want to put on. So SolarEdge is in the rear view mirror. Other trades that we talked about last week were extreme oversold trades. Allegiant ALGT, that one was an extreme oversold stock. I liked it, but it blew out of the gates right out of the beginning of the week. And we don't chase these stocks because weak stocks tend to get weaker. Great short squeeze here. I wish I was in it beforehand. We just found it too late. So the other one that we were looking at was IRBT. That was an extreme oversold stock. That also blew out of the gate. I had hoped that it would move lower. It didn't. We do not chase again. Do I like these as potential trades? Yeah, I do if I want to sell puts. Not so much the call side because these stocks can get bought out, the small companies, and it's a little bit too much risk. So it's a possible trade. I'm thinking another way here. And what I'm thinking about doing is looking for stocks that have had big moves. Because what I like to do when I open up strangles, and the strangle, if you're not familiar with what that is, it's the sale of a deep out of the money call option and then a sale of a deep out of the money put option, equal distance strikes. Now, sometimes you can do a ratio strangles. If you're bearish on a stock, you'll sell more calls, sell less puts, and vice versa. If you're bullish on a stock, you'll sell more puts, sell less calls, because selling puts is bullish. When you buy puts, it's bearish. So I said to myself, what do you want to do here? And I said, let's go back to the S&P 500 and see what's looking as promising that has already reported earnings. Why do we not want to trade earnings? Well, think about it this way. Here's Walmart. Now, Walmart reported earnings here on the 16th. Now, the anticipated market maker move was that Walmart, prior to earnings, if you have Thinkorswim, you ever want to find out what the market makers are pricing in the anticipated move at, that's how they're pricing the options. Just go to Thinkorswim trades tab, and in yellow here, you'll see the market maker anticipated move. At that point in time, there was a $4 anticipated market maker move. That's the typical range for Walmart post earnings. Didn't work out. Walmart came out with abysmal numbers, and the shares, they had closed around 169 and change. The next day, they closed at around 157 per share. That is hardly within the market maker anticipated range. Now, you'll see a lot of guys on YouTube saying how great it is to trade earnings. And I like to trade earnings myself, but I need a really big edge, because 2 and 3 standard deviation moves like this can occur. And your trade for that little bit of premium that you're getting paid is just, your past 5 trades are probably wiped out in profit. So you really need a good edge. And what I mean by an edge is that the market makers are anticipating a very big move. The options are very expensive, and you can go way out in time, way out in price, so that you're taking advantage of speculators just have really unreasonable risks of as to where the shares may be going, and you're selling premium to them. So I did not trade. I haven't traded any earnings at all this quarter because I just didn't have the edge. So, because remember, when you sell options on earnings, you have unlimited risk. Where you're an options buyer, they always say that buying options is risky. It's not. It's a very defined risk. The probabilities of you making money are improbable unless you have an edge. But as an options seller, an options writer, I have theoretically unlimited risk, especially to the call side. So this would have been a horrible trade. Option sellers here were wiped out if they got too big. So what I chose to do as we go into the new trading week is I like to go into the scanner. I have this scan for IV percentile, or basically how expensive are the options. And I sort the S&P 500 here by IV ranking, highest to lowest, and I do not trade the ones with blue next to them because they have yet to report earnings. I like to take a look at the ones that have a high IV ranking because what you can get is IV crush, meaning over the course of time, fear comes out of the stock and you could make a lot of money both on time decay and on IV crush. So I don't see a lot here at the top end. GE Healthcare, I don't know how much those options are really going to fetch. What did I just do? I just closed out my. There we go. I mean, you have a 73 handle on that. Notice I have no trades at current in this account. That will change this week. So what is that symbol? GEHC. My guess is that the markets here aren't very good. Probably wide bid-ask spreads. So let's play a game. Now, the way I do this is, what did I do? The wrong symbol? GEHC. So remember, when you're going into these trades, you want to worry first about the liquidity of the options, right? Sometimes it's easy enough to get into the trade, but getting out can be a little bit difficult. So you want to make sure that the options are liquid. And how you can tell that is you take a look at the volume, obviously, of the options. And you also take a look at the bid-ask spread. If there's a wide bid-ask spread at near the money options, walk away. You're not getting paid enough money for the risk, because you may have to get out of that trade quickly. And trust me, the market makers know how to squeeze you when you want to get out. So what I normally do here is this defaults to a 1 standard deviation. 68.27 is a 1 standard deviation move. That's the probability of success. That's not good enough for me. I like to bring it up to either A, this is the probability of closing in the money. I like to bring it up to touching. That's more equivalent to almost a 2 standard deviation move. So this gives me an edge over other traders. Allows me to sleep at night, just in case things go bad. So we can look at this stock and say, okay, I want to go out, probably only monthlies here. Yeah. I want to go out to, let's say, we'd have to do the January, oh, no, actually, no, December 19s. December 29. 83.20 call, 65 put, and having a big IV percentile, fat options, expensive options, allows you to get far away from the current share price. Not like selling at the money options on PMC Sierra in 2000. No, we don't do that. So what we want to do is, I don't know why they have stocks up here. Get rid of that. Add a leg. We're going to go out. December 29th. Those are quarterly expirations. We're going to go with the 85. We'll look at that first. call, 65 put. Yeah, you see, they're not going to pay you for getting that far away. You're not going to get paid. Even if you come down to an 80, nah, it's not worth it. Now, another way to look for opportunity is we don't have enough time for me to go through all of these symbols. But when I do execute these trades, I put the trade execution in the members forum. So if you're not currently a member, you want to subscribe, you'll get alerted. It's not like just simply stock alerts. You'll know why we're getting involved. I post the trade in the forum. See if anything else strikes me here. Pfizer, I would never trade that stock. Hewlett Packard, not loving it. Not loving it. Illumina is highly illiquid. Lululemon. This is a small account. It's a $400 stock. Let's play a game. The options are usually pretty good there. And I usually like to go out about 45 days. And the reason why we use that number when we're selling options is because we want to take advantage of the ramp up in time decay. At 45 days, that's when time decay really begins to eat away at the options. If you go out a year, I bought leaps on nat gas and on gold. Those options cost me little to nothing in terms of time decay because I went out so far. 45 days from expiration, it's going to be a completely different story. So when we're selling them, we like time decay. So we'll go out, say, to, again, December the 29th. I could probably only trade one contract in this account. 5, 1, 3, 3, 4, 5. So there's not going to be a $513 strike. We'll take a look at the 510s. Still not attractive here. It's not paying me enough. We need to get paid for our risk. Puts usually pay you more. So we could sell one contract. I don't know how many contracts they let me sell you, but you don't want to go use all your liquidity. I would probably feel comfortable doing 3 or 4 contracts. So if we sold this, we'd bring in a credit of $3.11 per contract. So you can see here that would generate proceeds of $1,238.69, excluding after fees, and that would be deposited into our account right then and there. And then the time decay begins. The question is, how do we want to do this trade? Do we want to do them both at the same time? I usually don't like to do that. And the reason is that automatically, because of the spread between the bid and the ask, if you execute both the call side and the put side, you're sitting looking at a loss for like the first week. And it just drives me nuts when I see that. So I did that for a while, and I said, there's got to be a better way, Bob. You're a technician, for Christ's sakes. Use the charts. Figure it out. So what I like to do now is I'll bring up the chart, and I'll look for an extended trade. It's just like we had with iRobot last week, extremely oversold. Same thing with the other stock, Agilent Travel. That was extremely oversold. Let's take a look at Lulu. Is it ripe for a pullback? You had good earnings. It's already begun to pull back here. So I wouldn't feel comfortable just selling a call right now, hoping for more of a pullback. Had I seen this trade on the 15th, I would have said, okay, I'll sell the call now. I'll wait for the pullback, and then I'll sell the put because it's ripe for a pullback. Right now, the horse has kind of left the stable. Now, the same thing is true for Microsoft. Now, Microsoft, I was short of last week using a call spread. And I'll remind you what that is. A call spread is when you sell an out of the money contract and then you buy a deeper out of the money contract. So let's say SEDG got bought out. Oh my God. If I have no protection to the call side, meaning I don't own a call above it, I have unlimited risk. So if a company says they're going to pay $190 to buy out SEDG and I sold a 100 strike call option, guess what I'm on the hook for? $80 a contract. That's not good. However, if you buy a call contract immediately above, say a 110, a 120, you're still going to take a loss, but that loss has a cap. Okay? And plus, when you do that, you reduce your buying power exposed to the trade because the broker has to think, hey, what's my max risk here? It's theoretically unlimited. So if I buy a put above where I sold the call, if I buy a call above the strike where I sold the call, well, they know exactly what the max loss is. And they say, okay, we're only going to take X amount away from his buying power because he's got insurance. Back to our story. So Microsoft, we were short using a call spread, and the trade began to really move to the upside, right? To the point where it was unsustainable. And so I had money, I've made a lot of money on the calls that I bought. And I said, God damn it here. You know, they came out with great numbers. I don't have to worry about earnings. The equity markets are beginning to break out strong here. I'm bullish on the market. Why not book profits on the hedge? Make them real. Because nobody's buying out Microsoft. And Microsoft stock is extremely extended. So the probabilities of a pullback are quite high. So that's exactly what we did. I booked that profit on the hedge, put that in my pocket. This is not in the small account. This is my large account. And then I sold puts on Microsoft. I can now sell more puts to create a ratio strangle on this new pullback because now I'm going to get paid for more for those puts because the shares are pulled back. So I hope Microsoft pulls back a little bit more, and then I'll sell more puts, and that will be a ratio strangle. And that puts me in a bullish position. So where I was short last week, I'm now neutral. And on a pullback in Microsoft stock, I'm going to be bullish. So I hope that makes sense. If you have any questions, ask me. I'm here for you. What else? We have a couple minutes left. Let's go back. What did I want to talk about here? So we talked about the conversions. We talked about Walmart. We already did a little bit of shopping for new trades. Let's do this. What I did here is this is a scan I ran last week. I did the extreme oversold trade, but I didn't do the overbought. So what I want to do this week is, since I'm not loving the opportunities that are being given to me on Thinkorswim, I'm going to use my own software, my own scan. And I changed this. Normally, this is RSI greater than 85. I brought it down to 78. So still very overbought, but you have more candidates that'll populate that bucket than if RSI 85. Frankly, I already ran it. There's nothing I would want to trade with RSI over 85. RSI 78, bingo. So let's run it. Run the scan. I like to sell premium on higher dollar stocks. You can see you have Ferrari up here. Those options aren't very liquid. And plus, it's a very expensive stock. Motorola Solutions, that's certainly a play. Qualcomm, I don't think that they've reported earnings yet, Qualcomm. I could be wrong about that. You want to make sure they've already reported earnings. They did. They reported. Oh, and they dropped like a rock. Oh, that's Walmart. Why is this not QCOM? Why is it not carrying over? QCOM. Okay, there we go. They reported in November, early November. So they've already reported. IV ranking is not great, but this is more of a directional play. I don't like the IV ranking at all. They're too cheap. Expedia. You can see how far this has gone. They've already reported earnings. How expensive are the options? Not very, but this is more of a directional play. So I'll tell you what I mean by that in a moment. Hey, TF Hatter. Hey, brother. So let's take a look at the chart, because what we want to do is we want to develop a strangle, right? We want to build a strangle, but we want to sell the calls first. And you may be saying, wait a minute. Whoa. Hold on there, big fella. Hold on there 1 minute. Are you out of your effing mind? This stock is in fuego. It's unsustainable. It's unsustainable. So what we want to do is we want to take advantage. This is kind of like jujitsu trading. It's contrarian trading at its finest. What we want to do is we want to use the pressure, the force that the bulls are applying to the stock, creating call skew, meaning they're making the speculators are buying these calls hand over fist, expecting EXPE to go to the moon. They don't realize that this is going to come to an end in the next couple of days. So, and I'm not saying that's going to crash or anything like that. You're going to get a pullback. You're going to get a pullback and consolidation. But that pullback and the consolidation is money in the bank to us when we sold a call already. Money in the bank, because the pullback decreases the value of the call skew. It reduces the value of the option vis-a-vis price action, because now the price is pulling back. People are willing to pay up big time for the options now. The options are going to decrease in value because nobody's going to want them. And then they're going to sit there, they can consolidate, and we can either A, book profits then and there, or B, stick with it and sell a put on the pullback because it's a healthy stock. So we're in a good decision-making position. So the question is, what do we want to sell? I still want to be somewhat conservative because we want to respect the stock, right? We want to appreciate the fact that this is going up for a reason. It's on fire. The first thing I want to do is I want to know where there's overhead supply, and I want to put my strike price above where there's overhead supply. And we're right there right now. So we're in a good spot. I'm liking the 150 price target. If you're not journaling your trades, start journaling, folks. Please. The question is, from a risk-reward perspective, is that safe, that strike price? So we can assume that we're going to have sellers, a lot of them, between where we closed on Friday, which was right at resistance, and where we want to sell our options. So now let's price it out. Let's take a look at our risk tool. This is what's going on here. This is not tagged right. There we go. Okay, EXPE. We want to go out to around that 45-day mark, and we could sell the 160s between 150 and 160 and be in a good spot here. 155, 160. And to the put side, we could price it out now, but we're not going to open up the puts right now. We want to do that later on any pullback. We'll look at the 115s. I'll do a print screen now and revisit it next week when we meet again, if we do the trade. So, as a matter of fact, what I'm going to do is I am going to do a print screen of this right now, and we'll revisit it next week. And it's always wise to diary your trades. I don't do it all the time, but I find a lot of value in it, especially when I'm wrong. Ah, I had so many keyboards and whatnot here. Okay, so I've saved all these. I'll show you what I'm looking at here. So these are all saved now. I have these for future reference so I can reflect back on. And as long as the shares don't gap down on Monday, I'll execute the trade, assuming I get filled. So the question is, do they pay us? Is it worth the trade to put on this risk? Hi, Bob and chat. YouTube notified. Awesome. That's good to hear. You tracking Twilio? TM. We'll go over like we do every Sunday night. We'll go over chart requests on Sunday night. So I'll make sure you remind me about them, and we'll take a look at it. Had a couple of dead cat bounce plays. Good for you. Congrats on the trades, pal. Nice. Always like to hear success stories. Okay, so we're going to stick with the 1229 strike. That's 42 days to expiration. If you go out too far to 63, you're not making enough time decay. You're the Jimmy Larry. You're the Jimmy Connor of stocks, Bob. Connor's attack tennis with tenacity. You do the same with stocks. We would not have a better team leader than you. Thank you very much, Larry. That means a lot. Thank you very much. Really do. Means a lot. So we're going to get rid of the put. Oh, we'll keep the put side on here just to get a feel for what we'll get paid. And we'll do a cost benefit analysis next week. So we'll go out on EXP. What was our strike? 155. Let's do 160s first. Oh, there are no 160s. 155 is the best we could do. Not loving it. I don't have to execute the trade to do the hindsight review. So let's do this anyway. Okay. So that way people can learn. So here we could probably open up 5 contracts without extending ourselves too much. Now, the put side, that's way too close to the money. We wanted to go down to the 115s. We're not going to get paid anything right now for the 115s, very little. So we want to sell them. Here, let's do a print screen of this. All right, so we have that. Now we want to get rid of this. And what we would do here is, again, independently open up the call side. And this is a very directional trade. If you open up both at the same time, that's non-directional. That's neutral. And eventually we'll get to neutrality. We don't care if the stock goes up or down. We're good. We love the time decay. So sell to open, say 5 contracts at the midpoint, generally. And they would deposit into our account, not a great amount of money for the amount of capital we'll be tying up, about $436. Now I could sell the calls here and just close them out on a pullback, but we'll just use this as a, I'm probably not going to trade this. You can probably hear it in my voice already. That doesn't mean we can't track it and track the strategy as well. So that's EXPE. I'll look for other better trades. It's certainly a candidate, not my favorite. I could move the strike down lower to around 150. That's certainly doable. I would probably put on a little bit less strikes because the shares are extended, and that would bring us in a few extra bucks. But that's not my favorite thing to do. I like to enter a trade with the best risk-reward probability. And the 150 is like a little bit too close to the edge for me. It's about roughly a 68% probability of profit. That may sound good. It's not good enough for me. I like 70% minimum, 80% or more. So that's EXPE. Let's take a look at some other names here. We'll close it out. Let's take a look at the 600. Broaden things out here a little bit. These will bring in some of the mid-cap names. A lot of these are not going to be liquid. I can already feel it. Look at Hawaiian Electric is on here. Nothing really exciting to me. Many of these have already reported, which is great. iRobot's still on here. But that train's left the station. Yeah, nothing here. I'm probably not going to find anything right now. I'm under pressure. Let's go back to what we could do is this, is reduce the scan to 75, RSI. Chipotle Mexican Grill ties up too much capital and the options are not very liquid. BlackRock's a no. Netflix. Happy dance. We have resistance on Netflix up at around 485. This is a 4-hour chart. Looks like it's setting up for a continuation move up higher. I think Netflix is going to keep going up higher. I'm excited. I'm getting excited here. Always something. Options are very cheap, but they're liquid. Let's play a game. We're taking a directional bet here on Netflix. We'll stick with the December 29s. Could you imagine doing this during a business day? You can't do it. You have to do this after hours or before hours. You can't work properly to do this during a trading day. Some people can, I'm sure. I'm not that smart. Too much else going on. So let's bring up Netflix. Let's see what type of premium they want to pay us. Now, the play here is that I think that they're going to rally Netflix on Monday. So our strikes at current, these are going to change, because if the shares do rally, I'm not going to trade the 535 calls. I'm going to go further out from the strike price. But let's pretend we're going to open up the trade right now. So we'll go with the 535s. There are no 535s. Let's go to the 540s. Not paying much. This is a lot of capital to tie up for 78 cents. Now, see, they won't let me execute this trade because it doesn't have sufficient funds on 5 contracts. But watch this. And this is what we did with a couple of other trades, is that, say we sold to open the 530s. We want to sell to open these. That's $1.27 credit. And then simultaneously buy the 570 strike. Now watch. 5 contracts. Now they let me place the order, because without the purchase of that 570 call, I have unlimited risk, theoretically unlimited risk. So what's the brokerage? You got to, a lot of times I hammer against the brokerages, but really, what are they supposed to do? How do you judge your risk? So when they know how much risk max I'm going to lose when I buy the put above. So we generate a credit here of $508. We minimize our risk by putting on that long call. And then on any pullback, let's take a look at the chart of daily chart of Netflix. And it was down on Friday. So that could have taken out some of the call skew, which will come back in if they rally it on Monday, Tuesday, whenever. Very extended on momentum here. Looks as though they're going to pop this higher. I can't believe we're near all-time highs here. Not all-time highs, 52-week highs. We want to know where our resistance is, overhead supply. And we want to sell that call above it. We're right there. We're at the precipice. So we're in a good spot here. Weekly view. Strong rally. Daily view. Very, very extended on Stokes. This is going to pull back fairly soon. You're going to have resistance at 485. We're looking to sell the 535s. We're good. We're good. So that's a potential trade with Netflix. And then when it pulls back, we'll sell puts. And we'll get paid more money for them rather than selling those puts right now. So we're going to wait for a continuation rally here on Netflix or Expedia. And then what we're going to do is we're going to sell the call. Then on any pullback, we're going to open up that put side. And if we're really bullish on the stock, for every 1 call, we'll sell 2 puts. Right? And with that, folks, thanks for being here. Don't forget, we go live on Sunday night, Sunday Night Future Live. Hit the subscribe bell. If you get any value out of this, like, subscribe. If you're watching this on the replay, please leave a comment. I'll get back to you, and use the list below, the link below, to join up our small account club list. These live streams are going to be going private in January for reasons I posted at the beginning of the video or the live stream. And also, if you're new to technical analysis, you want to learn charts, my top 5 favorite candlestick patterns, link below, take advantage of it. If you want to know when I execute these trades, these are not day trades. So these take a while to play out. So it's not as if you got to make a decision right then and there when I post a trade. Take your time. Ask me a question about it. If you want to join on the trade, join on the trade. If you don't want to, don't. Modify it if you want. So I'm there to engage you, and we have a Slack forum. You can see it's here. And we have a lot of great people in there. Hope to see you there. 14-day free trial below. Everybody have a awesome, awesome weekend. I'll talk to you tomorrow night on Sunday Night Futures Live. My biggest fight with my wife is paying quarterly taxes on. I don't do it. My accountant's just like, pay the fee. You're better off. Because I got to pay him to pay those taxes. So it's just better off. Just pay the fine for not paying. I had a bill, real quick. You're welcome, Sean. Anytime, pal. I had to pay my taxes back in 2000 again. And I wasn't filing quarterly. And the IRS sent me a bill for over $1 million. My $1 million tax bill. I call my accountant because I had no idea you're supposed to file quarterly. And for good reasons. Later on, I learned, to be honest with you. So I call him up and I'm like, I got a bill from the IRS for $1 million. And he goes, well, what they're doing is that they're assuming that every single one of your trades is profitable. And so they're sending you a bill for what you owe, or else you could file quarterly, pay me to pay your taxes on a quarterly basis 4 times a year rather than once. He's like, just pay the fine. Don't worry about that. I'll take care of it. And it went away. And I still, to this day, I'll get those notices from time to time. I ignore them. But that was the big shocker the first time I got that, $1 million tax bill. I should have framed that. All right, everybody have a great remainder of your weekend. I'll talk to you tomorrow night. Be well.